By the way, no Chatham House rules here. We spoke. If you want to attribute anything to us, we stand behind it. Feel free to quote away as you see fit. If you recognize my face or my voice, I've been told I sound like Ray Romano, but what can I do? I got to own that, right? I was also told in Las Vegas recently that I looked like a younger version of Harrison Ford, which I think is weird. Harrison Ford, Ray Romano, but it is what it is. I do appear in the media quite frequently. 2 weeks ago, I was down the street at the NASDAQ market site on CNBC Squawk Box. Last week, I was across the street on the Fox Business News. Just yesterday, I was on CNBC again in their New Jersey headquarters. I'll be on 3 media appearances tomorrow as well. I'm a contributor to Forbes. I wrote an academic book on ETFs. I write a weekly newsletter, Market Outlook, and then a quarterly newsletter called ETF Insights. Now it's updated to CEF and ETF Insights. Has about 65,000 subscribers. Don't be too impressed by that. It's free. So unless somebody opts out, they're basically getting that at the end of every quarter. The last thing I'll say, my relevance to this panel, outside of the voice and the movie actor stuff, is that I'm also the president and CIO of Smart Trust. We have 27 different UIT product strategies. If you don't know what a UIT is, it's another 40 Act product similar to an ETF or a mutual fund. Major difference being a UIT has a defined maturity date and the portfolio remains static over the life of each trust. Our flagship product is our Sustainable Impact Investing Trust, where we blend the ESG oriented, got to be careful there, ratings of Just Capital with the investment merits of a company as determined by Argus Research. It's one of our top selling strategies across the country. Very unique, very innovative, and I think flies very well in the face of all of the backlash on ESG in the last year. But that's enough about me. Again, I'm moderating, facilitating. I would love these 2 gentlemen to introduce themselves, and then we're going to jump into some juicy topics. So, Antonio, can you please start?
You're making me follow Ray Romano. Thank you. I don't know what TV character I look like, so you guys can guess. Maybe we can talk about it at the end. My name is Antonio Rodriguez. I'm the Director of Investment Strategy at the New York City Board of Education Retirement System, one of the 5 New York City retirement systems, currently $8 billion in fixed return assets. That's both the qualified pension plan and the tax-deferred annuity. We, like I said, one of the 5 New York City retirement systems. We are the retirement system essentially for everybody who works at a school that's not a teacher or a principal. So think crossing guards, custodians, who else? Cafeteria workers and occupational therapists. So, John, I'll turn it over to you.
John Lukomnik, a longtime institutional investor. I actually ran New York City's pension funds back in the 90s, so I've been an asset owner. I've been a fiduciary for over $100 billion in assets. I also have consulted to other asset owners with more than $1 trillion in assets around their fiduciary internal workings, as well as some external things. I've done a bunch of things because I'm old and not yet senile. So it's you become a compiler. It's like people get into the Hall of Fame, never having been great, but having been pretty good for years. So I've written 3 books, the last one of which, Moving Beyond Modern Portfolio Theory, Investing That Matters, is sort of it's a finance book. It's also an academic book, and I have an academic appointment at Columbia, and I taught at the Judge Business School at Cambridge. And it's how you deal with systemic risk issues. And Bill Burkhart and I took that and, for instance, helped the University Pension Plan of Ontario write their statement of investment beliefs. I'm going to consult with PGGM, the 230 billion euro pension manager in Zeist on Monday. So you'll apologize, I have to leave here early today, get to Washington to then go to Amsterdam, but it's a long story. And I'm thrilled to be here. I also earlier in my life actually worked as a risk manager, an outside risk manager for Legg Mason. So whatever type, I'm more interested nowadays in the systemic and systematic. We can get to differentiation of those risk issues than I am with the type of risk that most people deal with, but glad to go into any of them.
Fantastic, thank you. I think we'll all agree we have 2 experts on the panel. Their bios certainly speak for themselves. And I just want to start with defining risk. I mean, I think The title of this panel, Fund Risk Management in a Volatile Climate. Volatile climate, I can't think of a more understated term for where we are right now, not just in terms of the markets or economy, but also just in terms of the political climate. And if you think it's bad right now, wait till next year when things really start getting heated up for this next presidential election. But risk as a broad term, right? John touched upon it, market risk-wise, systematic risk, unsystematic risk. Some of the terms that we look at in terms of managing risk in this environment, political risk, headline risk, as was mentioned in an earlier panel. How do we define those types of risk with respect to our own individual responsibilities? I started my career at Lehman Brothers. I was actually a senior vice president there and the global head of risk management. Very different type of application of risk management at Lehman Brothers versus some of the roles that these two gentlemen play with regards to their individual capacities. A lot of people think volatility has died down in the markets this year, and that may be true when you compare it to last year, right? Last year, 1 in every 3 trading days involved a move of 1.5% or more in the S&P 500, 33% of the time. This year, it's down to about 11%. So volatility has dampened down, but does that mean the coast is clear? I certainly don't think the coast is clear. And the more and more I hear our Federal Reserve Chair speak, the more and more concerned that I get. But that's for another time. And don't quote me on that one. You can quote me on the other stuff. Keep that one out. Let me go back and rephrase it. He's doing a fantastic job under very difficult circumstances. So with that said, maybe we can both start. John, I'll go to you first, just with respect to your roles, your capacity, how you define risk, and some of the bigger risks that you see out there.
So there are a number of well-known risk consultants. And actually, in the book, we asked one of them if we could reproduce a chart. From Capital Market Risk Advisors, I should credit them. And it is a chart of the galaxy of risk. And it is literally stars, and it says like FX risk, daylight risk, duration risk, credit risk, country. It goes through all the risks. And the most important thing on that entire page is the 8-point legend on the bottom. It says partial listing. Right. And so really, those are causes of risk. Risk is an unwanted result. Or if you want to extend it ex ante, the potential of an unwanted result. Volatility is just a summary metric of all those things, of what's the band around a spot estimate. So it's actually a pretty bad measure of risk in some ways, good in others. And so really the question, I think, is, particularly for asset owners, what is it you're trying to do? For asset managers, my pet peeve is they all live in a relative return world, right? Where, oh, the market's down by 10, we outperform by 200, we're top decile. Great, I have 92 cents to defease my liabilities, right? Instead of 90 cents. I'd rather you underperform by 200 basis point in up 10 world. And so I think for a lot of asset owners, particularly those with liabilities, there are better measures of risk than did I beat a benchmark or what's the volatility. For instance, funded ratio. I said I'm going to see PGGM. They lost $40 billion last year. They're thrilled. They are so happy because it was a liability match. And when interest rates go up, your liabilities go down. Net, their funding status went way up, right? So what is it you're trying to do? And so my definition of risk is an unwanted result against an objective that you're trying to do.
I like it. I'm going to come back to you in a second to ask how that we can control those types of unwanted outcomes. But Antonio, you approach this from a very unique perspective, fiduciary perspective, in terms of what you need to do from liability management as well. Can you explain to the audience how you define risk?
And so I appreciate kind of John's thinking, because at the end of the day, we're beta investors, right? And so I want to define risk kind of in 4 parameters, right? The risk of for the portfolio, kind of the risk for the sponsor, the risk for future members, and then the risk of the organization. Actually, I'll actually start with the risk of the organization, because we oftentimes talk about how the investment management and the management of the portfolio should not be political, and I agree. But our existence is political. So to the degree that we have a license to operate, we have to think about that risk, right? And so we'll put that there. Second, the risk of portfolio, which I think certainly folks in the room think the most about. Again, as a beta investor, the short term, I care about volatility, but really the long term risk for me is I'm not where growth is, right? If we're not liability matched in the same width that a Dutch pension fund or a Canadian pension fund where our discount rate floats. So we have a discount rate that is currently 7%, and a discount rate that high. Certainly gotten a little easier now, but a discount rate that high means I need to be where growth is long term, right? So that's the risk to the portfolio. Risk to the sponsor is that we don't blow up the budget, right? That essentially that our cash flows are on the one side maintained, but at the same time aren't so large that suddenly instead of 9, 10, 11% of the city budget, it's 15, 16, 17, 18%, where you have to start having hard conversations about services. And then finally for our future members, because oftentimes you'll hear people talk about who bears the pecuniary or financial risk. It's the city taxpayers. I have two comments to that. First, our members are city taxpayers also, in addition to be beneficiaries. And then second, our future members do bear the risk, right? They'll get a worse benefit, right? And we have 6 tiers currently for New York City retirees that are not, fire or police. The tier 6 benefit is a lot worse than the tier 1 benefit. And so they do bear that financial risk long term. It's just, future members. And we have folks who are temporary employees who want to become future members, right? They can see that risk if they were working in 2011, right? The difference between your 2009 benefit and 2013 benefit is quite large. Lower crediting rate, things like that. So when I think about that, and then all of that can be, I think, discussed in going back to the portfolio, where if our portfolio returns are good enough, all of those risks, right? It's going to hammer our license to operate. It's going to hammer the sponsor's balance sheet. It's going to hammer, our funded ratio. It's going to hammer all of those. And so when I try to think about risk holistically, it is how does portfolio risk then manifest itself to other actors, other stakeholders, at the same time that we're managing the benefit for the beneficiaries who are ultimate stakeholders.
So in terms of portfolio management and construction and your funded ratios, from your seat, what do you see as the biggest risk now? Is it interest rate risk? Is it inflation? Is it concerns over the threat of a recession, if that's this year, next year, or the following year? Is it political risk? Is it all of them?
So because we have a kind of capped COLAs, I'm not that inflation. I mean, having a little bit higher inflation actually has not been that bad for us, right? Like especially locking in kind of labor contracts, that sort of thing. It gives you an idea that to a point, inflation is not that bad. I'm going to go a different direction. I'm going to go with the private markets, tail risk in private markets. And the reason I think about that is I have a decent handle on how volatility in the kind of manifests itself ultimately in my portfolio, but then also in our cash flows. So we smooth so much when it comes to that short-term volatility is actually not that big of a concern for us. However, I think volatility and risk in private markets manifest themselves in different ways. And they manifest themselves in 2 ways that I think are particularly difficult. The first is that, you don't get massive drawdowns, right? Essentially what happens is, either A, the marks kind of trickle down, or B, the marks kind of stay the same. And so the risks are, I throw good money after bad, essentially capital cost to fund businesses that aren't worth what the valuations say they are. And that's not coming back to me. And then the second is on the cash flow, I don't get distributions, right? And so I worry about a lot of zombies, right, on my kind of my balance sheet, so to speak. And so that net asset values that are going to remain sticky. And why that hurts is because if I take the hit now, then that means that I can smooth some of my cash flows, that the cash flow can come up from the sponsor. But if I'm, if on the book it says the net asset value is what it is, either cost or something like that, then I don't get them back, the cash flows back as quickly. So I'm concerned about, particularly in private equity, that we haven't kind of taken those markdowns to the same extent, and what that means for my out years.
All right, without any chuckles from the room, John and I are in the same demographic, as you could see with our white hair, but not necessarily everybody else is in this room is, and I don't think everybody else in this room has necessarily seen a lingering high interest rate environment that John and I may have been accustomed to over the longer span of our respective careers. The Fed has raised interest rates now 500 basis points over the last, let's call it 15 months. Significant, dramatic. don't know if you heard any testimony or outtakes from Chair Powell this morning, but he says there's a high likelihood that they're going to remain aggressive, further tighten this year because that damn labor market is still too strong. Wow. So we need to actually inflict pain and damage demand to help control inflation. Remember, the Fed has two mandates, right? Full employment and reasonable moderated prices. So they're throwing one out at the expense of the other. And now, since the beginning of the year, the Fed originally forecast unemployment to be 4.6% by the end of the year. They revised that down to 4.5, now to 4.1%. Full employment, we could have an academic debate about it, but it's roughly 3.5% in this country. So they think they have to bring down inflation by raising interest rates further to cripple the labor market so consumers can't spend as much. So with all of that as a backdrop, John, I'm not leading the witness here, but high interest rates going forward that could be higher. Do you see that as a risk, or are there other bigger risks out there from your seat?
It's funny you said that, because I was going to answer your question to Antonio about, what's the specific risks, with two parts. One is exactly where you were headed. So I serve on an advisory committee to Deloitte, which now obligates me to say nothing I say is officially a Deloitte statement, or a PCOB statement, or anyone else. But anyway, a year and a half ago, I started talking to their head of financial services, who is now actually the CEO of all of Deloitte Audit. And I said, here's what the problem with higher interest rates. First, you got a bunch of 32-year-old portfolio managers, including some.
I feel attacked.
At
Notwithstanding
leverage,
Antonio.
at hedge funds that employ lots of leverage, who have never seen an environment in which money costs something, and more importantly, liquidity isn't abundant and available. And there will be failures. And I started talking about banks. I got that one right, but I missed the fact that the intermediary was going to be crypto, right? First, then banks. And I think what you have to look at is any environment that is either working on a small margin where the assets can be impaired, as in the bank situation, or which has relied on continuous fundraising and available liquidity at 0% in effect. So that's it. The flip side of that, by the way, is, we forget the other side, which is a lot of older people, since you're mentioning that, would have said the last 15 years have been financial repression. I have to take risks. I can't save and put money in a bank account or a bond and earn anything to live on. So there's a flip side. But I'm actually going to answer that's not the risk that bothers me the most. I'm going to tell a quick story. When I was running the city's pension funds, I'm sitting in the office. You can imagine that that's a little bit of a busy situation to be in. You have 5 boards, as Antonio said. Each one has demanding elected trustees. You're doing everything from negotiating ISDAs to planning the city's cash flows, to overseeing managers, to researching new asset class, all the stuff you can imagine. I had 3 cancellations in a row one afternoon, and a moment to sit and think. And I had this epiphany, which 25 years later led to this book. And the epiphany was, all of this is bullshit. Now, not really, but it's just at the margins. I need someplace at the time, it's now 250 billion overall. It was 80 billion. I need someplace to put $80 billion to earn a rate of return above inflation, technically above the liability rate, but above inflation forever. Now, on the one hand, that's a really simplifying, wonderful epiphany. That's all I have to do. Find someplace to put $80 billion to earn a rate of return above inflation forever. On the other hand, nothing you're ever taught in modern portfolio theory or class ever deals with that, because it's dependent on a strong economy and a working capital market to translate the opportunities of the economy into investable opportunities. And that started me thinking about systems and system risk and things like that. And so to me, the bigger issue because we can all take actions. You can monitor your privates. Your private equity investments. I can, I can, I can change the duration of my portfolio. I can, whatever. System risk, whether it's climate change or country risk, or whatever, is subject to the tragedy of the commons, where I forget who it was that said we all have to do this and all be the good guys, right? And so things like climate change or lack of diversity or income inequality or anything which can harm that economy that I'm relying on, that I can't alone control, I can impact, and I argue for how we should impact and why we should impact, and that it makes economic sense to impact, and you can read all that stuff. But still, it's an argument. We weren't all taught to think that way. And so what worries me is that the ability to diversify and portfolio construct only affects, depending on what academic study you see, between 6 and 25% of your variability return. Systematic risk, by which I mean non-diversifiable market level price risk, is 75 to 94% of your return. That's dependent on working economic, social, and financial systems. So if I'm worried about something, I'm worried about the rule of law in the United States, climate change globally, things which have real ability to impact my portfolio, and I can do my part, but I can't unilaterally control.
Really, really interesting and thought-provoking. Now, since Philip's not here, I'm going to answer my own question as the third panelist, if you will. And the biggest risk that I see relates to all of us, right? 70% of our economy is dictated by the consumer spending, right? Right now, our Federal Reserve, again, they have two mandates: promote price stability and full employment. They're sacrificing one to try and bring in and rein in the other. As it stands right now, last year, US consumers put $180 billion of new credit card debt on, the highest on record. Know what the average is over the last 10 years? 43 billion. 180 billion last year. Let that sink in, marinate for a little bit. And the current level of credit card interest, nearly 21%, the highest on record. We've seen this story play out before, right? Consumers are continuing to spend. They're putting more in their credit cards. They're dipping more into their personal savings to keep up with these inflated prices. And now the Federal Reserve is focused on hurting demand further by driving up the unemployment rate, right? Unintended consequences. Will this push us into a deeper recession than would have otherwise occurred on its own? Can the Fed engineer a soft landing? Possibly. It depends on what the definition of a soft landing is. But if they continue to raise interest rates in the face of this, not even realizing the full impact of those 500 basis points in hikes thus far, then I think we could risk pushing this into an even deeper recession. And then next year, all of a sudden, we're cutting rates at a much higher velocity than the economy or any of us actually want.
I have to say, for all of you who think we're having academic discussion up here, these are actually actionable. For instance, if you believe what Kevin said, you should not be buying the equity tranches of securitized credit card debt. Really simple, right? We all, I mean, but we forget that that's what drove us into the last financial crisis.
Thank you.
Right? I mean,
Thank you.
And so one of the things that I think we all need to think about is, someone said belief system before, or values. Those do translate to financial insights. And that's one of them.
Well said. So now I'm going to shift a little bit to another type of risk. And I'm just going to read to you two bullet points that I wrote just this morning. BlackRock CEO Larry Fink. We all know Larry, right? Big proponent of ESG. BlackRock received a lot of backlash over the last year because of it, for right or wrong reasons. Said yesterday on Bloomberg that he is no longer using the term ESG because it has been totally weaponized. Still believes in its principles, will no longer refer to it as ESG. ESG, in his definition, has become a four-letter word even though it's a 3-letter acronym. Secondly, the mention of the term ESG during corporate earnings calls fell by 24% on a year-over-year basis. So whereas a lot of corporations were purporting their ESG principles, perhaps greenwashing, over the course of the last year, now they're backing away because of headline risk and political pressures. Where does that leave us as we look ahead? I'm very proud that we have our strategy that blends, again, Just Capital's rating systems, where they poll Americans to determine what they deem to be most important across 5 different stakeholder categories in defining the just behavior of a given corporation. How do they treat their employees? How do they treat their clients? Do they give back to the communities they operate within? Are they good stewards of the environment? And finally, how do they deliver returns to their shareholders? That's an important part of the investment equation, right? And then we blend Just ratings with the investment merits of the company as determined by Argus Research, looking purely at the stock's merits relative to the Just scores of the underlying companies. Put that together and we have a sustainable impact investing trust. I think that addresses exactly the risk management concerns that many of us have. What's the most important resource that any company has? They're people. They're people, right? It's not their products. It's not their intellectual property rights. It's not the assets that they own. It's their people. And if they can keep their people happy, continue to recruit good people, they'll continue to do good things. So why wouldn't we as portfolio managers place a value on those companies that treat their employees right, that give back to the communities they operate in, that are philanthropic? Won't they in fact be more sustainable? I certainly think so. But every time I have this conversation with clients, it delves into the world of climate change and the E in ESG. And if you look at Just polling, that's actually the lowest ranked of the 5 stakeholder categories by Americans. Still important, it's around a 9% weighting, but the lowest. So Americans are telling us that it matters, but these other attributes matter even more. So when I think about risk management, well, perhaps we should be looking at these other factors and building our portfolio strategies as well, without using the term that's now been totally weaponized, according to Larry Fink. So let's jump into it before we debate any longer. Antonio, you could start ESG, how you approach the term, the area, and go from there.
I've been on calls with other kind of investment directors from, across the country, right? And actually, I was a panel in CPERS where they, had somebody from West Virginia, somebody from California, from New York, and somebody from Missouri, right? You imagine, so we alternated, so it was a nice purple table. But I think look. I'm going to start at the top and then kind of go to, actually, let me start at the bottom, because when we have the conversations with portfolio managers, with the managers in our portfolio, I mean, at this point, it's table stakes for the incorporation, right? And so at the very least, even if up top there, folks are saying, hey, companies are discussing this less, or, in the press, ESG is called the 4-lettered word. In our conversations on what risk systems they're putting into place, where do they see investment impact, climate solutions, how they score the companies, how do they engage with management? I mean, I think us internally, that debate has been over for a long time. And so whatever you call it, that questionnaire is not going away. Those questions aren't going away. That information coming into our database isn't going away. At the top, and this goes to kind of our license to operate, we're certainly on the complete opposite end of that spectrum, right? Where I can't talk to my trustees, the comptroller can't talk to the trustees without having this as a portion of the conversation, right? And so to the degree that there is backlash, and you have to kind of expect the backlash, right? Like you think about it like a rubber band, right? Like, you're pushing forward, there's going to be some snapback. And so I think even with the backlash, I don't know how much that changes the actual day-to-day operation and discussions that we're having with the folks who manage our money.
John, love to hear your thoughts.
I'm going to, unfortunately, not talk my book, but talk my podcast for a second. I do this podcast. A couple of weeks ago, you can get it anywhere podcasts are done, but outside it with John Lukomnik, and I'm telling you for a reason. A couple of weeks ago, I did a podcast with Paul Clemens Hunt. I don't know how many of you know Paul. Paul was the United Nations official who invented the phrase ESG, sitting in an office building in Geneva. Paul is a former tabloid journalist. Like he said, I love gutter journalism, right? And he picked it for a serious reason, which is to get people to have a forward-looking risk process. But he picked the acronym to be catchy. I think he's also very smart. As he said, we're like 3 years, 10 years, whatever number you want to pick, into a regenerative economy. Anyone who knows the history of capitalism knows things get messy, right? Things don't progress in a straight line. And so what I think about the ESG debate are two things. First, when this started a year and a half ago with the model legislation and Mike Pence's speech, I said, this is going to be really ugly. There's going to be ugly politics for 5 years or so. But in the end, we win. And we win because given a debate between logic, economics, and international capital flows, and seeking political advantage from it, the capital flows and the logic win. But that doesn't mean it's not painful. You can get a lot of people hurt in 5 years of politics, right? You can go, if you're an asset manager, you can go out of business being on the wrong side of this. So I'm not trying to minimize it. I'm just trying to provide a context. I also think we are partially to blame. We meaning ESG advocates, and I helped co-found the ICGN some 30 years ago, so I guess I count. We have let ESG go from a process to think about forward-looking and hard-to-capture risks to be productized, and I'm not trying to disparage your product or Larry Fink's product or anyone else's product. I just want the reporters to know that was his comment, not mine. And that's the nature of it. But once it gets productized, unintended consequences happen. So, for instance, I'm on the board of a UCITS that is European. The amount of European regulation is huge, as you heard, but it's all based on portfolio holdings. So if I told you I had a portfolio holding of one stock Exxon, I'd say, what a horrible anti-ESG portfolio that was, except that was what Engine One did to try to move Exxon. And so instead of being thoughtful, process-oriented, we've become sort of doctrinaire, what's in your portfolio oriented, which I think is very similar to what you heard from the earlier panel in terms of a comment. And that enables you to go from process to product to politics. And so I understand Larry Fink's frustration. It does not, as Antonio said, conflict with the essential benefit of having a risk-seeking process, whether that risk is to the system or to enterprise value of an individual company. But I wouldn't be surprised to see less use of the word, because why wave a flag someone can shoot at when you can do the same thing without getting shot?
I really wonder if, because of all of this, because of all the intense scrutiny from the regulators on ESG-oriented funds or funds claiming to be ESG-oriented over the past couple of years, because of all the political backlash around whatever term you want, wokeism, or the opposite, greenwashing, do we actually come out better in the end because of all of this? If there's more scrutiny over how we apply ESG principles, the actual subjectivity or lack of subjectivity, more objectivity in rating systems, do we come out better in the long run as we move ourselves through these regulatory and often choppy political waters? And then I also think about what's the bigger risk? I mean, John really has me thinking now, is the bigger risk abandoning it altogether Or is the bigger risk not really considering those companies that treat their employees right, that provide fair and equitable workplaces, that give back to their communities that they operate in and are good stewards of the environment? Is the bigger risk not incorporating that if we really want to build longer term sustainable return producing portfolios? I'd have to argue the latter. And again, we're at this conference, of course, so I should be arguing the latter, but I think that's where the bigger risk is. And with any movement, responsible, sustainable impact investing, there's going to be some choppy waters. But I think it's going to allow us to actually work through those issues and create a more holistic framework that we could all use as portfolio managers to manage risk and deliver more sustainable returns. That's just my opinion, but I'd love to hear Antonio and John's.
One of the great parts about, I think, as a kind of investment director, to John's point around of a perpetuity, is that you only have to be a decent analyst. You have to be a really good synthesizer. And so one of the great things about John and Bill and the kind of thinking and having systemic thinking is that it does allow you can pick and choose or like kind of cobble together kind of an overall outlook. And so I think overall, it's, if there's anything that helps us, it's be systematic in your thinking, right? That's it, right? Like, and understand fiduciary duty or our exclusive benefit, our kind of duty to our beneficiaries and members, the risks to them and the risks to incorporate the risk to the sponsor and the risk to the organization and the risk to the society, right? I think if anything that comes out of this is volatility is important. It's not the only thing, right? And beta is boring, right? And I think that's kind of ultimately why we trouble ourselves over the 6 to 25% versus the 75 to 94%, because anyone also folks get paid off that I don't, but like other folks in the room do, right? Like on that percentage. So I think if anything kind of comes out of this, if it forces people to think systematically about risk, and then on the opportunity side, because again, at the end of the day, my longest term risk is I'm not where growth is, and growth is, again, unless they change the way that we operate. If I'm not where growth is and my beta is not high enough, my beneficiaries are not going to win either way.
Well said. We're going to leave room for one question because I know John has to catch a train and Antonio has a meeting after this as well. So John, if you can just give us a quick comment and we'll take one question.
Next.
That's a very quick comment. Very quick comment.
One two questions.
Jeff Gitterman.
Hey guys, nice presentation, thank you. I just wanted to ask a framing question, I guess, because all the debate around ESG has become, like we keep saying, a political topic, but at the end of the day, if you dig deep enough under the debate, it's a debate, I think, between shareholder capitalism and stakeholder capitalism. And at the end of the day, I was just wondering what you guys thought about trying to move the dialogue, because it's a lot more interesting to have a dialogue with someone and say, so what you're not interested in is stakeholder capitalism. You're not interested in your employees or your customers or your community that you're investing in, rather than fighting a term that no one understands what that term means anyway. So I think we should try to move the dialogue.
It's great.
Can I take this one?
I'll just say one point, and then it's all you, John. I'll just get over the course of the last year, Jeff, to kind of emphasize your point. One of our distribution partners reached out to us a year and a half ago, 2 years ago, and asked if we had any ESG-oriented trusts that they could put on their platform. I go, we don't have an ESG specific. We have a sustainable impact investing trust. Let us know when you have an ESG. So he didn't clearly understand. Same firm came back to us this year and wanted to make sure that we didn't have any ESG-oriented products on their platform. So that's where we're at. But John, go with it.
I'm going to reframe a little, because I don't think it's a battle between shareholder capitalism and sustainable capitalism. I think the way you're describing it is the way a lot of people, including the European Union, describe it. They have the single materiality, being outside in materiality. What do these factors do to a company and enterprise value? And inside out, meaning what does the company do to affect, and they put it, citizens and others. I think there's a feedback loop. And what you're really talking about is single materiality over a short term, versus what I would call systems level investing. Because what happens is, how does something become material to a company? Just on a traditional outside in to this company materiality. One of the ways things become material is when what the company does and what society's expectations are move far apart, right? In the 1920s, a charity in the UK devoted to women's issues tried to pay women the same as paying men. And they were sued and they lost because it was a squandering of charitable assets. Okay, wouldn't happen today. Before we knew about pollution, you didn't have to have scrubbers on a coal plant. It's a material risk today. And so what the marketplace is really doing, I think, is anticipating what will become material risks. We now call it double materiality. But the farther away what a corporate does from what society expects over time becomes even an outside in single materiality risk. And that's what's missing, is we tend to take things as it is today instead of projecting a sort of dynamic, what happens if things continue. The place that people do that is on climate. And you heard what the gentleman from the UN said about what happens to their funded status or their contribution rate if you look at it dynamically over time. And so I think that it's an interesting way to phrase it. I understand why you're phrasing it, and I think that 90% of the world would agree with how you're phrasing it, but I want to give you a different way to think about it, which is to think about this feedback loop of what becomes material over time.
That's why you're great, John.
Thank you, John. Thank you, Antonio. Lunch is served upstairs.